back to the Citizens Monetary Policy Committee discussions. We did have our discussion on Monday, but the massive US-India trade deal came on Tuesday morning or Monday night, and that's game-changing. The rupee itself went up by about 1.7% this week. And since our MPC members are top-rung economists, I thought we should ask them if the trade deal completely changes the ground for the Reserve Bank and for the Monetary Policy Committee. Let me welcome our members, Sonal Verma of Nomura, Sajjid Chinoy of JP Morgan, Samiran Chakraborty of Citi, Soumya Kanti Ghosh of State Bank, and the chairman of the Citizens MPC, Dr. Pronab Sen. Gentlemen, and Sonal, I'm deeply grateful that you all have agreed to come again and oblige me. Let me start with the lady. Sonal, now that the deal is signed, two top things that changed for the Reserve Bank.
Things change actually significantly and much for the better for the RBI. I would say there are mainly three ways things change. One is with this deal in place, it does add some upside risk to FY27 GDP growth projection. I think the biggest positive will be in terms of sentiment and flows into India, but also less trade policy uncertainty, improved exports. So there is some upside on growth. Second, this should actually enable better policy transmission, because in the last few months, managing FX and rates has essentially, undone some of the policy transmission. So with an improvement in flows, better liquidity, this should enable policy transmission going forward. And third, inflation in India, of course, was already quite benign, but to the extent that we do not see further currency weakness, any upside risk to inflation from weaker currency should also be offset. So it does make the growth inflation dynamic much better and enable better policy transmission for RBI going forward.
Okay, that sounds like even more Goldilocks, Sonal. Let me get on the budget. Samiran, do you think the change for RBI in terms of managing this 17.2 lakh crore borrowing program gets any easier because of the trade deal and likely dollar flows? Or is that still going to be a big point in the upcoming MPC?
I think I'll just extend the point that Sonal was making. I think the debate is between how much MPC will focus on being slightly hawkish because of the higher growth expectation versus how much dovish they can become now that there is less pressure on the currency and there is going to be better transmission of any future rate cuts. And that's where our bias is towards the latter, where we think that the MPC could turn a bit more dovish now compared to where they would have been if the deal was not in place. So from that perspective, the challenge for the bond market is twofold. One is that dovishness might, in the policy rate direction, might help the bond market. But on the other hand, these flows that are coming in would imply that RBI will have to do less amount of OMO, which is a negative for the bond market. So it will be a bit of a tussle on the policy day for RBI to balance this, that to what extent they are going to guide on the rate front versus to what extent they can still continue to signal a large amount of OMO. I think that's where the big debate is going to be, that can RBI on February 6th again announce a massive amount of OMO, or would they be now somewhat more, I would say, cautious in their announcements?
Okay, you suspect they may not announce such a big OMO. Actually, I'll come back to you, come back to the others on this, because after the budget, Samiran, I remember you telling me that it's not that 17.2 lakh crore, it is just that the demand side is very weak at this point in time. As you point out, let's discuss that later. But I'm even more worried about not just US trade deal. The thing that has changed this week, Sajjid, is the global backdrop. I mean, the swings we have seen in dollar itself, in commodities, and now in the AI stocks, or even the next rung of IT stocks. It's volatile, I won't say chaotic, but volatile global scene. How does that impinge on the MPC?
Absolutely, Latha. Good morning. I think, even though the trade deal is very constructive for India's outlook, we must be very mindful that the global backdrop remains very precarious. I think there are at least two tensions that the global backdrop is seeing. The first is that, for the longest time, we've seen the threats on US exceptionalism, and that's caused the dollar to weaken. And because of that, commodity prices have actually gone up because there's this inverse correlation between the dollar and commodities, which then also stokes inflation pressures in some economies. But what we've seen over the last week is the fact that underlying growth in the US, and in fact in large parts of the world, remain very resilient. And I think that's the tension, that US growth is holding up very nicely. Chairman Walsh, who was appointed by President Trump, is much more mainstream than was feared. And with this growth inflation, and inflation in the US is sticky, there is a growing belief that the 50 basis points of rate cuts that markets have priced in for the Fed will not happen in 2026. And so the longer that belief continues, the more the pressure on the dollar to regain some of its losses. And that's what we've seen in the last week, that the dollar has begun to rebound. And if that process continues, that will put more pressure on emerging market currencies. So we're not out of the woods just as yet. The second tension, as I mentioned, is the AI tension. Yes, technology is doing very well in December and Jan. Tech exports are still doing well. CapEx is doing well. But there is now a growing belief every month that has this rally been overdone? Are we approaching bubble territory? And as 2026 goes on, those questions will only get more acute. So I think we have to be mindful here that the global backdrop is very precarious. If those Fed rate cuts get priced out and the dollar were to strengthen, that will put more pressure on emerging market currencies. Conversely, if the dollar were to continue weakening, then commodity prices go up, and that creates pipeline inflation pressure. So, there is no free lunch here.
Oh, yes. I'll ask you about the Asian inflation or disinflation in a bit. Soumya Kanti Ghosh, I wanted your view on the currency. When we spoke on Monday, we were worrying whether it come to a point where the Reserve Bank has to announce even some NRI bonds or resurgent India bonds. Now, what is the view? Will RBI actually move to stop appreciation? This is not an MPC question; it's an RBI question. Do you think they will have to stop appreciation? Will it come to that?
No, thank you, Latha. I think the larger debate is that the US trade deal is very positive from the currency perspective. But I would just like to add one thing, that we have to be cautious enough, because the things actually globally has not changed anything fundamentally in the last 2 days, or not it is going to change in the next month or so. The global debt levels, they become precarious. The movements in US dollar could be sideways. It could either appreciate or it could depreciate. And we have seen in the past that the rupee actually has been depreciating along with the dollar, which has been never happened. And while this news of US trade deal has actually created a positive sentiment in the market in terms of a rupee appreciation, but I think that given the precarious uncertainties, the uncertain nature of the dollar movement, and also of the capital inflows, I think the central bank will get a very well-meant reprieve in terms of not thinking about the liquidity, that impossible trinity at this point of time. But my sense is that we have to be cautious because the volatility in the market is not yet done yet. So if your specific question that the RBI should actually stop appreciating, I think the time has not come. Okay. Maybe the central bank could look through the data in the meanwhile and then take decisions accordingly.
I take your point. It's too early, but there is that expectation in the market whether Reserve Bank should stop appreciation. That changes the arithmetic even for how much currency, how much reserves are available in the system, the liquidity in the system. Dr. Sen, if you can bring all this together, sir, for the MPC member, post this deal, do the growth inflation dynamics become easier to manage? You would be less worried as a central banker.
Not necessarily, Latha. Let me just try. One thing that we seem to be not putting enough focus on, as far as the trade deal is concerned, is we've talked a fair amount about what it means about our exports. But there's going to be a huge amount of rejigging of our import.
Yes.
On the import side.
Yes.
Now, that is going to have monetary consequences. We don't know how large or how strong this is going to be, but given the fact that we've been running a large trade surplus vis-a-vis the US, what this is going to mean in its essence is we're going to have to import a lot more from the US. And that means that we will be diversifying our basket of imports across the world. Now, this has consequences not just for the Indian economy, it has consequences for an already uncertain global economy. And that becomes problematic.
Yeah.
So as far as uncertainties are concerned, one major source of uncertainty is gone, which is what we had talked about the last time we met. But the uncertainty is still very much there, simply because now you're going to see us changing the way we trade with the rest of the world.
Yeah.
Now, this is something that one has to be a little careful about.
Yeah. I take your
And
points.
in the context, one has to keep in mind the movement that was happening towards moving to a BRICS currency kind of arrangement. That is going to be taking a bit of a setback as of now.
Yep.
Which means that, again, we really now need to, in a sense, batten down the hatches, look internally, because the rest of the world is still going to be volatile. We will not know how it's going to change.
Yep.
And we have to look for internal sources of growth. And therefore, to my mind, at the moment, the trade-off is that growth imperatives have become more important than they were earlier.
Oh. So
Not the other way around.
Okay, sir, that's very, very interesting. Actually, we should invite you all for a separate discussion on this import rejig that we will have to do and the potential impact it can have on current account deficit. It's early days yet, we don't know. But, you know, we have a MPC coming up. And so first, lady and gentlemen, let's take up your pens and do the first vote. What will the MPC do to the repo rate on February 6th itself? Sonal, I'll start with you.
On hold.
On hold. Samiran?
On hold, but
Okay.
a bit more dovishness than expected before.
Okay. Davish, pause. Soumya?
No change.
Sajjid?
No change, on hold.
Okay. All of you are on the same page. Dr. Sen, you want to change your vote?
Hold.
Hold. Okay. So by a majority, by a unanimous vote, no change. But we will have to ask you a lot more questions about the new CPI basket, the new GDP number series that we will have, and you know, a host of other things that the MP that will bother the MPC. Those questions after the break. For Bazaar viewers, at the moment it'll be Chartbusters.
वकील साहब